Kevin Green. So Kevin, what is the street looking out for from NIO?
Yeah, expecting a little bit of implied volatility or some volatility post this report here. The market's expecting around 12.4% move either to the upside or downside post the earnings. And unfortunately, we are seeing a slide here when you're looking at pretty much the whole EV space this morning. A lot of these stocks are down about 4%.
Analysis, evaluation, and consideration. There's been a buzz in the financial world lately about NIO's stock price taking a dip of around 30 to 40%, raising eyebrows among investors. Wall Street analysts have chimed in, offering their projections for the next 12 months. But before jumping on the bandwagon, it's crucial to delve into both the positive and negative aspects of NIO's situation. Are the recent developments a red flag or a golden opportunity?
When you're looking at the Chinese EV makers, they're not that profitable, to say the least. Even if you look at BYD, which really focuses on not only EVs, but also hybrids, their margins are very, very low. I mean, you're kind of looking at the same type of ICE type of margins where there could be between 4% to, let's say, 8.5%, 9%. So they have to churn out more vehicles or sell more vehicles in order to be profitable here. That's a little bit different than what we see from Tesla, which Tesla has probably the highest margins in the EV space here. So they don't have to sell as many cars in order to turn a profit. But once again, we see these price wars happening in China and even in the Eurozone, and that's putting pressures on margins across the board here. So NIO definitely has a significant amount of market share, but once again, they're just not up to the production level yet.
We can't deny NIO's popularity among EV enthusiasts. With tens of thousands of vehicles sold and nearly $8 billion in revenue last year, it's clear the company has made significant strides. However, despite its fan base, NIO's stock has been on a downward trend, plummeting by 40% since the start of the year. This puts its current price just 4% higher than it was 5 years ago, a stark contrast to Tesla's staggering 823% surge over the same period. But there's more to NIO's story than meets the eye. Despite its stock woes, there are notable strengths in its investment case. The company has demonstrated its ability to design, engineer, manufacture, and market cars at scale, setting it apart from many competitors. Additionally, NIO has made substantial investments in a battery swapping network, addressing a crucial barrier to EV adoption: battery range. Yet, amid these positives, there are still massive concerns. While NIO's revenue saw a healthy 13% increase last year, its net losses ballooned by 43%, reaching almost $3 billion. This disparity between revenue growth and mounting losses raises red flags about the company's long-term sustainability. While it's not uncommon for vehicle companies, including Tesla, to incur losses in their early years, the widening gap between revenue and losses for NIO is cause for concern. Building a robust supply chain, manufacturing capacity, and sales network comes at a massive cost, but the pace at which NIO's losses are outpacing revenue growth is alarming. Now, it's not just ordinary investors whose eyes are on NIO. Analysts and institutional investors are closely monitoring the company's performance. Recently, HSBC analyst Yuqian Ding adjusted his NIO stock price target, lowering it from $10.20 to $7.90 while maintaining a buy rating. Ding was taken aback by NIO's fourth quarter net loss, particularly underestimating its marketing research and development costs. Despite this, Ding remains optimistic, believing that NIO has already factored in potential headwinds and anticipates improvements in margins and volume starting in Q2. Furthermore, institutional ownership provides valuable insights into investor sentiment. During Q4, 468 13F filers disclosed their stake in NIO stock, with a total of 415.61 million shares owned, an increase from the previous quarter. Hedge funds, in particular, exhibited bullish behavior, with the total shares owned increasing by 30% to 59.85 million shares. NIO's largest institutional shareholders are CYVN Investments, Tencent Holdings, Baillie Gifford, BlackRock, and State Street. These institutional investors play a significant role in providing liquidity and support for NIO stock. Adding to the excitement for investors, Chinese electric vehicle manufacturer NIO recently inked a partnership deal with battery giant CATL. The collaboration aims to develop longer-lasting batteries, a move geared towards reducing overall EV costs. NIO's founder and CEO, William Li, emphasized the importance of addressing battery life, calling it a critical issue for both NIO and the entire industry. With EV battery warranties typically covering 8 years, NIO highlighted the impending expiration of nearly 20 million EV battery warranties in China between 2025 and 2032. This underscores the need for extended battery lifespan solutions. NIO stated that its research efforts have successfully extended the lifespan of swappable batteries, retaining 80% of capacity after 12 years. Moreover, NIO announced a significant reduction of up to 33% in monthly rental fees for batteries, part of its battery rental scheme aimed at lowering EV purchase costs. Bolstered by a $3 billion investment from Abu Dhabi investor CYVN Holdings, NIO has intensified efforts to achieve profitability by streamlining its workforce and deferring long-term investments. Despite trimming its workforce, NIO remains committed to investing in core technologies like batteries. The company has commercialized 150 kilowatt-hour semi-solid-state batteries for its EVs, boasting a range of up to 1,000 kilometers. Additionally, NIO has made substantial investments in infrastructure for battery charging and swapping, with thousands of swapping stations and public charging stations currently in operation. NIO's focus on battery swapping as a solution to ease the strain on power grids during peak times aligns with industry expectations. However, the widespread adoption of swapping stations hinges on the standardization of batteries. NIO's upcoming second brand, Lideo, set to debut in May, underscores the company's commitment to catering to a broader consumer base. Currently sourcing most of its batteries from CATL, NIO is exploring partnerships with new battery suppliers like CALB. These strategic moves underscore NIO's commitment to innovation and addressing key challenges in the EV market. But before we move on, we just want to thank you for watching this far. Now, investors might wonder why analyst Tim Xiao remains bullish on NIO stock despite recent setbacks. Xiao's optimism stems from NIO's fourth quarter loss falling within his expected range. Additionally, he was encouraged by a significant increase in the company's cash reserves following a strategic investment from CYVN in December. Moreover, NIO managed to improve its vehicle margin by 90 basis points in the fourth quarter, reaching 11.9%. This improvement was attributed to lower battery costs, as highlighted in the company's Q4 earnings report. Despite NIO's stock being down approximately 35% since the beginning of the year, Xiao maintains his price target of $13 per share, suggesting a remarkable 140% upside potential. Meanwhile, Wall Street has set some intriguing forecasts for NIO. Just over a month ago, analysts were quite bullish, with the average 12-month price target hovering around $10.86, representing a whopping 90% increase from the stock's then current price. However, this optimism was amidst concerns of an EV bubble burst and the downtrend in Chinese stocks. Despite recent positive market performance, NIO's stock ratings have become more divided. Out of 12 analysts on TipRanks, 5 rates it as a buy, 1 as a sell, and 6 as neutral. Interestingly, while the average rating remains of moderate buy, there's been a noticeable decline in 12-month price targets. For instance, Citigroup's recent projection was 40 cents lower than the average target in February. NIO's technical analysis reflects this mixed sentiment, with oscillators signaling a buy while moving averages suggest a strong sell on monthly charts. However, recent performance shows signs of improvement, with the stock experiencing gains in the last 30 days and the past week. Nonetheless, NIO still grapples with significant year-to-date and 52-week declines, underscoring the challenges it faces despite short-term gains. But as always, it's crucial to stress the importance of thorough research and analysis before investing in NIO or any stock. We encourage you to stay informed and exercise caution in their investment decisions. With the volatility and uncertainties in the market, being well-informed can mitigate risks and lead to more successful outcomes. So, what's your take on NIO's future? A promising opportunity or a risky bet? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about NIO's Q4 earnings report, just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.